Thank you for joining us today. A healthy stock market is said to climb a wall of worry. Over time, as one worry subsides, another rises to replace it. It's in fact a dangerous sign when this doesn't occur. Today, as COVID vaccinations and previously infected help us approach herd immunity, inflation is taking root as the new main worry. Given the unprecedented stimulus from round after round of COVID relief bills, an inflation spike of some magnitude has to occur. The questions are how large and long-lasting these inflationary pressures will be. Investors my age and older will vividly remember the runaway inflation of the 1970s. The worry is that this might occur again, and if it does, we'll need to repeat the moves Fed Chair Volcker made back then to break inflation's back, which were economically painful. The early 1970s endured a perfect storm of the nifty 50 stock market bubble burst, the shock of a major oil embargo, and President Nixon's Fed chair pursuing extended easy money policies. By the middle to the end of that decade, inflation ran as high as 10%, and 10-year treasuries exceeded 15%. Volcker ending that spawned the great bond bull market of the past 40 years. It took 2 decades for inflation to return to historically normal levels. And over the past decade, inflation has been lower than most alive today can remember. This environment has obviously been good for stocks, but rising inflation could be even better. When inflation rises, real assets like housing and companies with the pricing power to pass along increasing costs do well. Financial assets like bonds, by contrast, are hard hit. At present, the Fed and most economists don't forecast rising inflation in the near term, but most expect a post-COVID spike at some point. Others, like Wharton professor Jeremy Siegel, expect inflation to move into the 4 to 5% range and endure for a period of time. Regardless, the Fed has made clear they will let the economy run hot for the foreseeable future, and both scenarios should be good for stocks. Adam will review asset class returns, which are striking in many cases, and then Andy will share some of the tactical maneuvers we've made as the market transitions from pandemic to post-pandemic. Adam will conclude with several tax considerations for the year ahead.
Thanks, Lowell. And first, what we'll do is what we're accustomed to each quarter, and taking a snapshot of what's happened over the past several months in some of the major broad asset classes. And the story this quarter is really one of the 2 sides of a coin. You've got the equity markets, which for Q1, unlike Q1 of last year, all posted very consistent positive returns that trend well above their longer-term averages. So you've noticed a pretty consistent rally, whether you're looking in the domestic market or overseas in developed or emerging economies. And you also saw a very nice rebound in traded real estate, which was hit hard at the early part of last year when concerns were out there around, a return to work and what that meant for real estate long term. The bond market, on the other hand, certainly took a hit from a spike in interest rates that was driven by an excitement around the reopening of the global economy and a lot of positive momentum in global growth driven by, the reopening itself, but also a lot of the support that's being provided by the government and also central banks. So this past quarter ended up being the worst quarter for the bond market, in a long time, really since the early 2000s, and then back some, in the 90s, there were several bond market sell-offs as rates were going up and down, and there was volatility. But in terms of what's happened the last 3 months, it's really something we haven't seen, or bond investors haven't seen in quite some time. So whether it's domestic or overseas, it was a negative quarter for bonds, and it was a positive quarter for stocks. And it was in contrast, again, to the same, the opposite story of last year. And this starts to paint the picture of diversification and the asset allocation decision-making process. But, when you think about the building blocks of a portfolio and, the major inputs, you really have 3 categories. You've got stocks and you've got bonds. But you also have a third bucket that we tend to leave off of these webinars just because of how broad in nature and specific they can be, but that's alternatives. So investments like managed futures and private debt that are not directly tied to the returns of the stocks and bond markets that actually provide a great deal of diversification. And, for the clients that we're managing their portfolios in a diversified way and taking it through the lens of an asset allocation approach, we're big believers in alternative, and that's reflected in those client accounts. And you've noticed, just like this year with the difference in stock and bond returns, and last year vice versa, notice alternatives have been pretty steady through a lot of the volatility, depending on which market you're looking at. So it provides a great source of additional diversification for those that are worried about, really heavy bond exposure, or if you've got, a significant portion of your assets in bonds and have not explored alternatives. We're going to be making a conscious effort to have a webinar specific to alternatives and the benefits that they provide in the context of overall asset allocation. So that's a third piece of this that's normally left out that I just wanted to highlight briefly. But in summary, great quarter for equities. And then when you go to look at some of the intermediate and longer term trends, you see on a 1, 5, and 10-year basis, a similar story that we've been discussing for the past several quarters now. You look at the 1-year returns of the stock market, driven really by coming out of the March 23rd bottom of the market into this year, and how strong the rally's been and how global it's been. And when you go to look back 5 and 10 years, you notice the consistent positive returns that we've all experienced. But you also start to, again, see some additional themes play out. And just like we talked in the context of alternatives in your asset allocation, if you look at these 10-year numbers, you notice a very stark difference in the returns of domestic markets versus international markets. And some of the questions we received leading into the webinar were, is now a time to just reconsider my overall mix between, domestic and overseas markets in my equity bucket? And the answer is, absolutely. In terms of just asking that question and revisiting that conversation, that's what, our advisors are discussing with their clients in terms of, how are we balanced across global markets? A piece of that is, what should I be holding domestic versus overseas? But I think another angle of this ties directly to the U.S. market, which is within the U.S. stock market, what's really driven returns over the last decade especially. And, something Andy will touch on is, when you look at the divergence in returns between large cap and small cap in value and growth, we know for one that's cyclical in nature. The size and style of return cycles, tend to last several years in length. This one has been a little more prolonged in its course, but we're big believers that, although you look at the relative attractiveness of domestic versus overseas, within domestic markets, there's still a fantastic opportunity to the tune of value stocks and still small cap stocks. So that's why we think, from an active approach of both, handling the domestic piece of the portfolio, but also looking at the decision of domestic versus international, all of those things are important to consider. But, certainly when you're weighing and balancing things out from an asset mix standpoint, you want to start to consider, what should I have here versus what should I have over internationally. And then from an economic standpoint, it's been, a lot of the same story as it was last quarter. You've got a majority of the world in an economic expansion, and you've got that driven by the reopening of the global economy. You get continued support from the Federal Reserve and now the government, with the $2 trillion or so economic impact payments delivered earlier this year, the continued increase in unemployment benefits. And so you've got a tremendous amount of wind behind the sails of the economy. And on top of that, you've got corporate profits that are recovering from an all-time low last year. So the expectation for profit recovery is significant, and that should really help, keep the markets in a position where there's, remaining room for price appreciation. Now, again, what Andy will touch on is where is that going to come from? We've seen growth come from different pockets of the market for different reasons, but we're big believers that we're about to hit another phase of this recovery that we want to be well positioned for. So that's just an important active consideration within the portfolio. And then, the final piece of this that's really going to be interesting to watch unfold is the impact on the economy and the market of a lot of the pent-up demand that we've had as a result of the pandemic. So you think of not only the amount of money that's been transferred from the government into the citizens' bank accounts, but you also have people that have been unable to spend money on a lot of things that they normally would have been spending on. So you think about, whether it's, buying a new car or specifically going out and traveling and taking vacations and going to see family and friends. And that's an element of this that'll be really, it's tough to quantify. There's a lot of talk about the $1 trillion or so that's just sitting there waiting to be spent or either invested as well. And, it's hard to put a number to that. And that'll be part of this whole reopening story that'll be really exciting to see, but positive nonetheless. So, again, the tune is, certainly positive economic news, positive in terms of the current direction of the markets. And then Andy will dive into our strategies specific to that and what we've been doing lately and what we're planning for the near future.
Yeah, thanks, Adam. And yeah, certainly things feel a lot more optimistic this spring than it did last spring. One of the things that I'm having a hard time not doing is just thinking back at how things were a year ago at the exact same time. We had COVID surging all around us. We really knew very little about the virus to begin with, especially relative to what we know now. And I think the reality was just beginning to set in that these lockdowns were going to last longer than the 2 weeks or a month that was initially promised. Restaurants remain closed. We were doing, if you're anything like me, you were doing Zoom hangouts with your friends and family rather than actually seeing them in person. There just didn't seem to be any light at the end of the tunnel back then. I mean, uncertainty certainly seemed everywhere. But the paradox of all that is that with market crashes, they're actually quite patterned and predictable. I mean, sure, you never know exactly where the bottom is or how long it's going to last. But in a perverse sort of way, we almost get excited here when we do get these big market disruptions because of the opportunity created. So, let's revisit here what I mean by breaking down some of the investment actions that we did in your portfolios here over the last year. And really, the first thing that we did was shift into small cap stocks. These next few slides are literally copied and pasted from the webinar we did on March 25th, 2020, where we provided an update on our investment strategies. In this webinar, we announced that the first move we were going to make in response to the big sell-off was to shift into small caps and overweight small cap stocks because they tend to outperform during the market recovery that takes place after a market bottom. So we showed here that in 2008, a year later after the market bottom, small caps outperformed large caps by 20%. And if we go to the next slide, the next correction that took place was in 2011. This was more modest, but we still did see small caps outperform large caps. And then in 2016, we had another correction where, again, strong performance out of the small cap stocks. So our expectation around this time last year was that this trend would again take place in 2020. So the question kind of, phrased the same way here, how did that all turn out? So even it was an even stronger small cap rally than those corrections and bear markets that we just ran through. In fact, from the market bottom on March 23rd until the end of March 2021, small caps outperformed large caps by 43 percentage points. And by the time small caps really started rallying in October, your portfolio had already been positioned to take advantage of this move since, the end of March and certainly by the end of the second quarter. And so when we talk about being size and style responsive, this is truly what we mean. It's crucial to have the flexibility to lean into these types of opportunities as they present themselves. The other big opportunity that we had from all this is stock selection. So, I think anyone who's a client of ours knows that stock selection has been central to our process since the company's founding back in 1974. And so we know quite a bit of how our stock selection model works. And we know that it tends to underperform in the recoveries following these big market sell-offs. So one thing that we do to correct for this is we actually build models that are trained on the aftermath of big corrections in bear markets. So, to give you an example of what might come out of this model is if our normal model might want to buy Comcast, our distressed interval model might want to buy Zillow. And really, I do think this is one of the best things to ever come out of our research department, this distressed interval model, and certainly since the time that I've been here. So, in late March, we actually turned this model on and began implementing it alongside our shift into small caps. And so, again, I asked the question, how did it do? Here we see the rolling 1 month effectiveness of this signal. And the way that we measure effectiveness is we take the group of stocks that the model rates as viable, and we just simply compare it to the group of stocks that it says we should be selling. And so what we see here is we had 3 real big peaks. The first one in the immediate aftermath of the market bottom on March 23rd. We routinely saw massive performance gaps between these 2 groups of stocks, as high as almost 25% over a 1 month time frame, which is a huge amount of potential alpha to have with these stocks. But one thing to note is even when we weren't at a peak, like we saw late summer, early fall, we still saw consistent performance from our model, where the scale of this chart makes a 5% difference between our buys and sells look relatively modest, but that's a number we would normally be very happy with anytime we get it. But basically what we were saying is our distressed interval model that we turned on performed just as we expected. In fact, we began positioning portfolios in those first few months starting at the very end of March. And by the time we got to the second big peak here, we had portfolios fully implementing our new distressed interval signal. And we know that this has been a big tailwind to our portfolios, and some of the best performing stocks that we purchased over the course of the year were the result of this model. The question we have from here, though, is how much longer can the signal continue adding value? Again, this model is trained on past market recovery periods, so we know that it won't remain effective forever. And on one hand, in the past, we've seen effectiveness typically last somewhere around 2 years following the market bottom. But the COVID recovery has been unusually fast and unusually strong. So we think the signal may not remain effective as long as normal. The most recent time frame on this chart in the past week or two, we've seen some of the effectiveness wane, which does happen from time to time, but still, it's something we are monitoring closely as we decide when to turn the model off. But the good news is that when we do decide to eventually turn this off, we do have another exciting enhancement to our stock selection model that's ready to take the handoff. We first started experimenting with advanced data techniques to improve our stock selection model by, messing around with some neural network models in the late 1990s. But at the time, it proved that computer processing just wasn't powerful enough, and the amount of data out there maybe wasn't broad enough for these advanced techniques to really add value. But more recently, we have again been doing a deep due diligence process on a cutting edge signal that uses big data scraped from the web to predict a company's revenue for a given quarter. This machine learning algorithm gets data from a company's digital assets, like their apps and their websites, and also from search results and social media engagement to measure the level of customer engagement. It then uses this data to predict whether the company will beat or miss on its revenue estimates. We've been testing this signal in live portfolios since 2019 to verify some strong back-tested results that we got. And what we've learned is that it helps specifically with the timing of our purchase decisions. So we expect to be using this new signal in conjunction with our standard stock selection model as soon as we turned off our distressed scoring model, and expect it to materially add value to our portfolio construction process. And finally, let's talk about what we expect to drive performance the rest of 2021. The other big bet we have on right now is a sizable tilt towards value companies. And we explained in our last webinar what we mean by value and growth, and talked about why value appears undervalued to growth today. And I wanted to share some promising data that shows the next leg in the so-called reopening trade seems to be a value rally. This chart here shows performance of value relative to growth month by month since 2000. So when the bars are above the origin, that means we were in a pro-value month. And when it's below the origin, that means we were in a pro-growth month. We know that the pandemic trade that lasted the first 9 months of 2020 was unusual in the sense that each month from January to September, we saw growth outperform value. And this was unusual both for the magnitude of the growth performance, but also the length of the streak. But starting in October, we started to see that trend change, and value momentum has really begun to take hold. This makes a lot of sense, as industries that are heavily comprised of value are the ones benefiting the most from the reopening. Think about your financials, your industrials, or communication services and energy sectors. Historically, these industries have a strong correlation with GDP, which is expected to take off. So we're betting on this trend continuing and gaining momentum for the rest of the year. Now, to close out our presentation, I'm going to turn the floor back over to Adam to talk about tax considerations in 2021.
Thanks, Andy. And yeah, just to wrap things up, we know it's just about that time of year. Everyone's thinking about taxes, whether or not you've already filed your return or just about to in the closing weeks here. One of the big initiatives our advisors are, working through with clients is first and foremost, taking a really good snapshot at what happened last year. We've invested a lot in tools and technology to help us really look under the hood of your tax return and tax situation. If that's something you're interested in, to get a really good gauge of important elements of an overall tax outlook, which is, what's your marginal bracket? What are you paying in terms of capital gains? Are you taking advantage of all of the necessary credits and deductions that are now available, especially in light of a lot of the tax law changes that occurred, over the past several years? So, really understanding where you're coming from is going to be critical, and we've got the tools, resources, and staff on hand to help with that. First and foremost, leaning on your a dedicated advisor. And the second piece of that is, how do we use that information to plan for the future? We've really been honing in with clients on, how to handle taxes as it relates to life transitions, like getting a new job, retirement, drastic income changes, or big investments that need to be, changes that are needed. Having a good baseline and being able to use that to plan is a valuable exercise, and we're here to help work through that with you. The other piece of this is we've been fielding a lot of questions about, what's going to happen with tax rates. Are we in line for an immediate, bump in rates, whether it be income rates or capital gains rates, and what's going to change with taxes, or what's the likelihood of a change occurring? And I'd say, currently with the makeup of Washington and, where party lines are drawn and what their initiatives are currently and how those are being communicated in terms of their priority, I think it's fairly safe to say that the odds of any major tax overhaul over the next 12 months is limited. So I wouldn't say that's a high probability event. There certainly seems to be other things that are taking order of importance, especially when you look at, the recovery and coming out of the pandemic. So the probability of any major bumps in tax rates over the next year seems to be on the low end of the spectrum. And then once we get beyond that, we'll have to survive through, things like the 2022 midterm elections. And then before you know it, we're already talking about, another presidential race. And that's just tends to be how these things work and how quickly these cycles move, and why it makes it so hard for anything in Washington usually to get done. But I think over longer periods of time, you look at the debt level and you look at where we are, we're helping our clients at least plan and concept for a future increase in tax rates. Maybe not, this year, next year, but in the future, given where we are. So that's why it's really important to connect with your advisor, start to talk about taxes, have that conversation so we can get ahead of it and see what might be best for you on a more personal note. So thanks everyone for bearing with us regarding the technical difficulties here. We will edit this up and post it on the website. It'll be recorded. So if you have any questions, you can certainly go back and rewatch. And also our team here will be in close contact with everyone to get time on the calendar to speak as we head into the summer. So thanks again. Let us know how else we can help, and enjoy the rest of your week.